Welcome back to the deep dive. If you're like us, you want to be well informed, but you just don't have time to wade through hundreds of pages of financial reports and investor calls. We do that for you. Today, we are taking on a big one. It's a deep dive into the Q1 fiscal 2026 performance data for one of the world's largest consulting firms. And this period, it ended November 30, 2025. These guys are pretty much the canary in the coal mine for global corporate spending. So our mission today is, well, it's twofold. First, decode their financial health, and second, figure out what they're really trying to tell us about the speed of the AI revolution.
Right. And the thing that just immediately stands out, the TLDR for you, is this story of aggressive realignment meeting, just incredibly robust demand. This quarter was all about spending money to change the business while growing it at the same time. New bookings were extremely strong. We're talking $20.9 billion.
$20.9 billion.
Yeah, that's a 10% jump in local currency, a serious number.
That's staggering. It really suggests that corporate demand isn't softening at all.
Not even a little. And you can see that in the client concentration. They had 33 different clients who each booked over $100 million of work in just one quarter.
Wow.
And on the revenue side, they hit the very top of their guided range, $18.7 billion. So that's a solid 5% growth in local currency. But the really critical part is their profitability. It stayed strong, even with huge restructuring costs. We'll get into the whole adjusted versus GAAP thing later, but their adjusted earnings per share grew 10% to $3.94.
So they're managing to pull off this really expensive workforce pivot without, derailing the whole train.
Exactly.
Okay, so let's unpack that $18.7 billion in revenue. Where's the money actually moving? When you break down the type of work they do, it's split between consulting and managed services, and the revenue is almost a perfect 50-50 split. But the growth rates, they tell a very different and, I think, a much clearer strategic story.
They really do.
Yeah.
So you have consulting at $9.41 billion, and that's your high-margin, project-based transformation work.
Yeah.
But it only grew 3% in local currency.
Only 3%, okay.
The real momentum, and this is key, is in managed services. So that's the longer-term, running the systems, outsourcing kind of work. That segment brought in $9.33 billion and grew much faster, 7%.
So if the higher growth is in these long, stable managed services contracts, what does that tell you about what clients are actually looking for right now? Are they moving past the advice phase and just saying, look, can you just come in and run this for us?
That is exactly what's happening. It suggests clients are shifting from asking, what should we do, which is consulting, to, can you run this for us at scale? And use automation to make it cheaper, which is managed services.
And that provides a much more stable foundation for future revenue, right?
A much stronger foundation. And the bookings back that up. Managed services bookings were $11.06 billion, which just slightly outpaced the consulting bookings at $9.88 billion. The book-to-bill ratio of 1.1, it just signals really healthy, sticky future revenue.
That makes a lot of sense. Okay, let's pivot to the geographical map. Did this demand hold up everywhere? I know the Americas is their biggest market.
It is, yeah. It generated $9.08 billion, but its growth was, just okay. 4% in local currency. EMEA was the same, also 4%.
So where was the fire?
The clear regional winner, by a mile, was Asia Pacific. They led the pack with a 9% growth rate, hitting $2.73 billion.
9% in APAC. What's driving that kind of acceleration over there?
Well, Asia Pacific often lags the West a little in the initial digitalization wave. But once they decide to move, they move incredibly fast, aggressively. This 9% suggests a massive coordinated push on scale digital transformation, probably in financial services and high-tech manufacturing.
Okay, so let's follow that thought directly to the industry breakdown because we saw some huge differences there. Financial services just surged, up 12% in local currency to $3.6 billion. Why is that sector so hot right now?
Financial services is always, always under this dual pressure. You've got regulatory compliance on one side and the desperate need to get rid of old, complex core technology on the other. Right now, they are arguably the earliest, most aggressive adopters of scaled Gen AI. They're using it to manage risk, to automate these incredibly complex back-office processes. That 12% growth tells you they are pouring money into AI.
And communications, media, and tech was also strong, right? Up 8%. I assume that's just keeping up with the infrastructure demands of AI itself.
That's it, exactly.
But the real anomaly here is health and public service. That segment really lagged. It actually went down a slight decrease of 1%, even though it's a huge part of their business at $3.8 billion. Is this a sign they're losing ground in the public sector, or are those clients just, I don't know, hitting the pause button?
It's likely a mix. The public sector, just has slower budget cycles, especially the U.S. federal business, which we know is going through its own restructuring. But it could also just be a capacity issue. I mean, the private sector, financial services, tech expert, they're absorbing all the available top-tier talent for this high-value AI work. It could be pushing public sector projects down the queue.
Okay, this is where we move from that top-line story to the real internal tension of the quarter. Profitability versus reinvention. And for you listening, it's really important to get the difference between GAAP and adjusted results because this company spent $308 million to reshape itself this quarter.
And that's the cost of modernization. It's what it costs to get ready for the future. They are actively shedding old costs and finishing this huge talent rotation program to get their workforce aligned with an AI-first world. So that $308 million charge for business optimization, that's primarily employee severance. It's a one-time hit they have to take to get leaner and sharper for the long run.
So when you just look at the raw GAAP numbers, the ones that include that one-time hit, it kind of looks like the business took a step backward.
It does on the surface, temporarily. The reported GAAP operating margin decreased 140 basis points. So for you listening, 100 basis points is 1 percentage point. So that's a 1.4% drop in margin.
Ouch.
Yeah. And the GAAP diluted EPS, it decreased 1% to $3.54. So it looks messy.
But if you pull out that $308 million cost, the cost of renovating the house, basically the underlying business looks very different.
Completely different. The adjusted operating margin actually expanded. It went up by 30 basis points to 17%, and the adjusted EPS shot up 10% to $3.94. This is management's core message right here. They're saying the underlying engine is getting more efficient and more profitable precisely because they're making these painful cuts right now.
And to give you a broader sense of that efficiency, their latest 12-month return metrics are, well, they're really impressive. Return on invested capital, or ROIC, is at 21%.
Which is just fantastic. It means they are incredibly efficient at turning capital into profit. Return on equity is 25%. These numbers show they know how to deploy capital.
And that capital is certainly moving. They generated strong free cash flow of $1.5 billion. That's a huge jump from, $0.87 billion this time last year.
Right. And having that much cash allows them to be really aggressive with shareholder returns. They returned a massive $3.3 billion to shareholders in Q1 alone.
$3.3 billion. That's a staggering amount of cash to send back. It included $1 billion in dividends, and they've already declared a 10% increase for the Q2 dividend. But the bulk of that was share repurchases, $2.3 billion. This isn't just a routine buyback program. This is management screaming from the rooftops that they are confident in their future and they think their stock is undervalued.
Even as they're spending hundreds of millions on restructuring, it's a huge vote of confidence.
Okay, let's turn to the strategic centerpiece of this whole deep dive. This is where the narrative shifts from just reporting numbers to sending a massive signal about the future. We're talking about advanced AI, and this is where it gets really interesting.
This quarter is both the peak and the end for their standalone AI metrics. The momentum was just undeniable. Q1 advanced AI bookings hit $2.2 billion.
Which is a 76% increase year over year?
76%. And revenue was even more explosive. It hit $1.1 billion, growing 120%. This is the proof that clients are done with pilots. They are executing now.
And they're investing in the people to do it. They're getting close to their goal of 80,000 AI and data professionals, and they started what they call agentic AI training for the whole company.
And that phrase, agentic AI, is so important. It means they aren't just training people on how to use AI tools. They're training them to deploy AI agents that can handle complex, multi-step tasks all by themselves.
So it's about building automation that doesn't need a human to check in at every single step.
Exactly.
It's
true automation.
That growth is spectacular. I mean, 120%. So what's the catch? Why on earth would they announce that they're going to stop reporting these amazing advanced AI numbers after this quarter? That just seems totally counterintuitive.
This is the defining strategic pivot. And it's probably the most important thing for you to take away from this. The company's reasoning is that advanced AI is now, and I'm quoting here, embedded in some way across nearly everything we do.
Okay.
Clients are not asking for a little AI project on the side anymore. They're demanding huge end-to-end solutions where AI is just,
Yeah.
it's just part of the plumbing.
So it's like a car company suddenly deciding to stop reporting separately on airbag sales.
That's a perfect analogy.
It's not a feature anymore. It's just an essential, expected piece of the basic infrastructure. If they can't even isolate it to report on it, it means AI is now the cost of entry for any digital project.
Precisely. It's the default operating model. And they can't do it alone. They rely so heavily on their partners. Over 60% of their Q1 revenue was driven by their top 10 ecosystem partners, the hyperscalers.
Microsoft, AWS, Google Cloud.
Right, because you can't deliver Gen AI at scale without that cloud infrastructure. And that partner-driven part of their business is growing faster than their company average.
So it makes sense they'd get even closer to the companies making the AI engines themselves. They specifically highlighted partners like NVIDIA, Databricks, OpenAI, Anthropic.
Snowflake, Palantir, they're integrating the entire AI value chain. And they're even investing in the physical layer.
What do you mean?
This quarter, they acquired a majority stake in a company called DLB Associates. Why? To get better at capital projects, specifically targeting the high-growth data center consulting market. It's a direct move to capture the growth from building the physical infrastructure needed to run all this AI.
Okay, so if we connect this massive AI pivot to the bigger picture, then the way they price and deliver their work, it has to change, right? You can't sell this new world on an old business model.
You absolutely cannot. You have to move away from the old time and materials model, where clients just paid you by the hour no matter what the result was.
Because that model is just, it's fundamentally broken when you introduce AI and automation. The firm is incentivized to take more hours, but the client wants the AI to do it in less time. The incentives are totally misaligned.
Exactly. So they've been pushing hard towards fixed price work. They reported that roughly 60% of their work in fiscal 25 was fixed price. That's up about 10 percentage points in just 3 years.
And that fixed price model is sort of the bridge to the future then. It forces the consulting firm to take on the risk. If they can automate a task and do it faster, they keep the upside.
It creates total alignment. And once you master fixed price, you can start moving to real outcome-based models, where your fee is literally tied to the business results you deliver. We get paid if we reduce your operating costs by 20%.
And while they say that's still a very modest share of their business, you can see that's the direction of travel.
It's where all of this is heading. And they're building the capabilities to guarantee those outcomes with units like Accenture Song. We think of Song as the creative ad agency part of the business, but it's so much more now.
It's really the whole customer-facing engine.
The entire digital customer engine. Design, products, sales, marketing, customer service. Yes, creative is part of it, but the ultimate goal is to lower the cost to serve by applying AI and automation to that entire customer journey. They're selling operational excellence, not just a Super Bowl ad.
So, given this huge strategic shift happening internally, what does it all mean for the rest of the year? Let's look at the forward guidance. I'd imagine stability would be the key message here.
And that's what they delivered. They largely confirmed their full-year outlook for fiscal 26, which speaks volumes about management's confidence. Revenue growth is still guided at 2 to 5% in local currency.
And if you strip out the drag from their U.S. federal business, the core commercial business expectation is more like 3 to 6%.
Correct. And profitability targets are holding firm. The adjusted operating margin is still expected between 15.7 and 15.9%. Adjusted EPS still looking at $13.52 to $13.90, a healthy 5 to 8% increase.
So the engine is running smoothly.
And they expect it to keep generating a ton of cash. Full-year free cash flow is forecast between $9.8 and $10.5 billion.
Okay, and just to close the loop on this, let's revisit the people metrics that support this whole strategy.
Right. We mentioned the severance costs, and that lines up with the headcount number. There are 783,691 employees. That's actually a 2% decrease year over year.
So they are shrinking the overall footprint, which makes space for those 80,000 AI specialists they're bringing in.
It's a clear move to get leaner and prioritize specialized skills over generalized labor, but the people who remain are very busy and very committed. Utilization is high at 93%, and voluntary attrition is stable at 13% annualized. They're keeping the people they want to keep.
So what's the core takeaway here when you put it all together?
The core takeaway is that this firm is moving incredibly aggressively to future-proof its business. Their financial growth is now completely tied to embedding AI everywhere. And that's forcing them to change how they report their numbers and, more importantly, how they engage with clients. They are successfully making that very difficult transition from an old school advisor to a true AI-driven operational partner.
And that leads us to the final provocative thought for you to take with you. The moment a global leader like this stops tracking advanced AI as its own separate thing, it suggests we've passed a point of no return. AI is no longer a specialty, it's a utility like electricity. So if a firm this big can no longer even isolate its AI sales, what does that imply about the necessary speed and depth of AI adoption for every single company out there that's trying to stay competitive and well informed today? That's the challenge to think about. We'll see you next time on The Deep Dive.